Hey everybody, it's Khalfani-Cox, the money coach, and I wanted to talk to you guys about what's happening in the banking world, because I know a lot of you have been hearing the news and the headlines about bank failures, and you might be worried thinking, is my money safe at a bank? What should I do? I'm gonna break it all down for you. So first, let me preview this video by telling you that I'll answer the quick and dirty questions right up front, but then I want to take a little bit of a deep dive for those of you who want to hang, who want to learn, who want to get a little bit more into the thick of it to better understand our banking system and how different aspects of the financial world affect your wallet. So hang with me as long as you can. I expect this is going to be, I don't know, maybe 5 or 10 minutes or so, because I really do want to explain to you what's going on and how it impacts you and what is being done about all this. So right off the bat, let me tell you that we've had 3 bank failures in March of 2023. And 2 of these bank failures were actually the biggest in history. So first we had a crypto lending firm that went under called Silvergate. We're not going to focus so much on that. It's the latter 2 that have been in the news lately and that have, I think, far more significance. So the second one was Silicon Valley Bank, and the third one was Signature Bank. So Silicon Valley Bank, obviously, as you might suspect, is out in California in the Silicon Valley region. They actually catered mostly to tech companies. Those were the main depositors who put money into that particular institution. They had, of course, individual clients as well, typically tech bros, a lot of people who worked in the tech industry, executives at startups, and so forth. Then out in New York with Signature Bank, they also catered primarily to high net worth individuals, and they were taken over by state regulators. Okay, so now these 2 institutions had large amounts of deposits at one point in time. At Silicon Valley Bank, they had about $200 billion in assets, and Signature Bank had about $88 billion in assets. So these weren't small places. Silicon Valley was the 16th largest bank in the country. So obviously, one of the biggest things that have rattled folks is that they're worried about the prospects of so-called financial contagion. And that just basically means, like, is this going to spread? Are other banks going to go under? And again, is my money safe? So the first thing I want to tell you right off the bat is that, yes, I really do believe that even though the banking system is clearly under stress right now, clearly there's fractures in the system. You don't just get bank failures, for nothing. For the vast majority of folks out there, for like 99% of Americans, yes, of course, 100% your money is safe. And honestly, right now, based on what federal regulators are doing, for 100% of people, your money is safe. And here's why. The Federal Reserve, the Treasury Department, and the FDIC have all stepped in to protect those customers of Silicon Valley Bank and Signature Bank. What have they done? Well, typically, as you probably know, if you have money on deposit with an institution, it's covered by FDIC insurance. So if you have a checking account, a savings account, a money market account, if you have money orders, etc., those things are protected at a bank or credit union. At the bank, it's up to $250,000 in FDIC insurance coverage that protects you, right? If the bank fails or goes under. Well, in this case, those 3 entities that I mentioned, the Fed, the Treasury Department, and FDIC, they said, tell you what, for all of you depositors, not only are we going to make you whole and cover you and make sure that even though this bank has failed because there's been a run on the bank, and we'll talk about that in a second, we're going to cover you beyond that. So those of you who had deposits, those of you companies, and those of you individuals, again, rich, high net worth individuals for the most part, who had deposits in excess of $250,000, we'll cover you too. We'll make sure that you don't suffer any losses. And guess what? those institutions had about 90% of their deposits were actually uninsured. So imagine this, the typical client who came in there, high net worth, wealthy, sometimes uber wealthy individuals or companies, they had deposits in excess of $250,000, $500,000, $1 million, whatever the number is that they had, and they're also going to be protected. So right now, bottom line is the Federal Reserve, the FDIC, the Treasury Department, they're trying to show, listen, we're going to calm the market's fears. We're going to take heroic, unprecedented measures. We're going to do something, out of the box here. And we're going to make sure that all of these customers' funds are protected. And we're going to backstop in a way that we've never done it before. They've also created a new credit facility. They created this, $25 billion essentially new fund to give other banks the ability to get loans if necessary. And we'll talk about that a little bit more too. But for right now, I just want you to know, in general, yes, your money is safe at a bank. It's not very likely at all that the major banks, the largest, say top 10 largest banks, are going to see any runs on their, money in terms of depositors trying to hairpin quickly get the money out, that kind of thing. And that's essentially what a run on the bank is. It's when a whole bunch of depositors seek money back out of the bank because they're fearful or they just need it for some reason. And that tends to be a cycle, that the more fear that grips the marketplace, the more people say, let me hairpin quickly get my money out. And then that bank run spirals. So Silicon Valley, as you might know, is part of the tech hub in our, nation. It's one of many tech, kind of primo locations. So what have you been hearing about lately in the news? A lot of tech layoffs, right? So we've had the Fed raising interest rates, and that's been in part driving a lot of layoffs because companies can't afford to borrow at the same level, just like individuals or consumers can't afford to borrow at the same level because the cost of borrowing has risen. And so when companies can't fund their operations, can't borrow, etc., they start looking at cost-cutting measures and headcount. Employees typically represent about 70% of the average business's cost of doing business. So the first place they look is, where can I cut? I can cut at headcount. So we've seen a lot of layoffs in the tech sector. So I'm not even surprised that a lot of those, tech bros, let's call them, a lot of those folks who worked in that industry, especially in Silicon Valley, if they had deposits on hand with Silicon Valley Bank, that they either needed their money because they have been laid off or they are, in a different financial position, or they're just reacting to market fears and jitters, and then that accelerates, okay? So not only were these banks, taken over by regulators and seized, but, people are just looking at what are the broader implications for us, everyday folks. And so that's part of what I want to address too, because I want to make sure that you guys are understanding sort of, not just why the banks failed, but how the system works, right? So some of you may have seen a Wall Street Journal op-ed piece that ran that essentially said, maybe the board at Silicon Valley Bank was distracted by diversity concerns. And the writer, this was a very laughable op-ed piece in my opinion, but the writer pointed out that the board of 12 people had, one black person on the board. They had, several women on the board, and that their board was in total like 45% diverse. And that maybe, this is what the op-ed writer said at the Wall Street Journal. He was like, I'm not saying that 12 white men would have avoided this, but maybe if the board wasn't so distracted thinking about diversity, they would have done a better job here and they would have overseen this. And no, that's not what happened, okay? Not by a long shot. First of all, there's a ton of research out there that has demonstrated that boards that are diversified and companies that are diversified in their management ranks, in their employee levels, etc., do far better and they outperform their peers. So let's just put that notion to rest. And then secondly, if we want to talk about blame and what happened and why it is that Silicon Valley Bank in particular failed, I think there's a couple of things that we should note in terms of, if we want to point the fingers and where the blame come. There's a lot of finger pointing we can do. There's a lot of blame to go around. I would look at, just right off the top very quickly, 4 different areas where we can point blame. Congress, former President Trump, the Fed, and the executives at Silicon Valley Bank itself. Okay, let me tell you quickly why I'm pointing out these 4. Congress. So back in 2008, when we had the last financial crisis, when we had the banking crisis and Bear Stearns collapse and Lehman Brothers collapse, and there was a mortgage meltdown. I don't know how many of you guys remember that, but there was bank bailouts that happened. And in the wake of that, we had reform measures put in place. The Dodd-Frank legislation in particular, President Obama signed that. And the gist of it, without getting too wonky and going way too in the weeds, is that it was, designed to provide certain levels of consumer protection. We didn't want to see like all these big institutions that were quote unquote too big to fail. We didn't want to have banks or financial institutions that were so large or had so much influence without the adequate regulatory provisions in place and the right amount of consumer protections in place to make sure that if a bank ever failed, that it wouldn't like take down the entire economic system. So we had sort of tight controls put in place with Dodd-Frank. Okay, well, 10 years later, the banking industry, of course, never liked this. They didn't necessarily want to have an extreme amount of regulation. And I get it, no industry likes to have what they perceive to be an excessive amount of regulation. But we always have to strike a balance, right, between an adequate amount of regulation and kind of a free market economy being able to do what it does and having safeguards and consumer protections in place. But what I'm trying to say here is that the banking industry never liked this. A lot of, financial folks didn't like it. The lobbyists for the banking industry didn't like it. They lobbied, they, kind of pushed against it for about a decade. And sure enough, 10 years later in 2018, under former President Trump, they repealed or kind of did away with some of those protections that were afforded under Dodd-Frank, okay? Now, I'm not just blaming former President Trump. He signed it into legislation. However, Congress approved it. Both parties, the Democrats and the Republicans, signed off on this. They sent it to his desk. So that's why I'm putting Congress on blast as well. So Trump, Congress, there's for them. What about the Fed? I mentioned the Fed and I mentioned the executives at Silicon Valley Bank. Well, obviously the Fed has been on a massive battle against inflation. They've been trying to cool the economy and to tame this 40-year high that we've seen in inflation. So the Fed actually has 2 mandates. The Fed's role is to, keep prices under control, keep prices in check. In other words, tame and, keep inflation at a moderate level. And right now they've set a target of 2% inflation. And we're still at inflation, above 6%. So they're still trying to battle inflation. They want to cool off the economy by raising interest rates. And they're thinking that by raising interest rates, we're going to tighten the money supply because the cost of borrowing is going to be a lot more out of reach, frankly, for a lot of people, whether that's for institutions, companies, or for individuals. And so then prices as a result will follow because there'll be less demand for those products and services because people can't borrow in order to finance their purchases. Okay, that's a quick and dirty explanation. But in addition to keeping prices at a moderate level, the Fed's second mandate is to deal with employment and is to kind of maximize employment. But the Fed has almost been practically singularly focused on fighting inflation, because of course, everybody was complaining about it. And it is a real thing. We had like runaway prices. Y'all remember when gas prices were out of control? Obviously, we've had housing prices spike through the roof, a whole bunch of things, right? So in reaction to that, the Fed started hiking interest rates. So I'm going to explain to you in a moment what that means in terms of hiking interest rates, because I want you to better understand the language and the terminology. But first, I'm just noting, because I just want to put a bookmark on this and come back to this. I'm just noting that a lot of people are saying, look, the Fed messed up here. You know, they went on this aggressive rate hike spree, and that has caused a lot of problems in the economy. And so some people are pointing the finger at the Fed, and yes, we can absolutely look at the Fed's policies and whether or not they've been effective. So that's another one. But the last one I wanted to get to before I talk about the Fed and interest rates and things of that nature is the executives themselves that I mentioned who were at Silicon Valley Bank. Okay, so I want to explain to you kind of what happened there and why it is that I'm like, what were y'all doing? You know, like this is part of Econ 101. So let me explain to you why it is, in my opinion, the main reason that Silicon Valley Bank failed. One, was mismanagement by the executives. And two, yes, it was absolutely tied to and in relation to the Fed's actions in terms of raising interest rates so aggressively. They're very much intertwined. Okay, so what happened? Well, at Silicon Valley Bank, just like every other bank, they have deposits from people who put money in the bank. So I want to explain to you how this works. So when depositors put their money, on deposit at an institution, then that firm can go ahead and make loans or do stuff with the money, right? So you and I might put our money on hand at a Chase, a Citibank, a Bank of America, a Black-owned bank, a regional bank, or a company like Silicon Valley Bank, right? Then those institutions can turn around and use the money to do things. They can offer people, business loans. They can offer mortgages, etc., right? Or they can invest the money and try to get a higher rate of return on what they're actually getting versus what they're paying out in terms of savings. Because if you have savings there, they might have to pay you, or they do have to pay you typically, some money to have your savings attached to them, right? Okay, so what did Silicon Valley Bank executives do with the money that they received? Well, as it turns out, in large part, they put it into bonds. They put it into long-dated treasuries. Treasuries are securities issued by the U.S. government, into municipal securities, but essentially they put them into bonds. Now, I'm thinking like, why would y'all do that? Knowing that the interest rate environment that we're in, knowing that a year ago, the Fed has embarked on this super aggressive interest rate hike initiative in order to cool off the economy. And Powell and the rest of the folks at the Federal Reserve have been real clear about saying, we're going to keep raising interest rates. We're going to keep raising interest rates because we're trying to clamp down on inflation. So again, Econ 101, here's what happens. When interest rates rise, bond prices fall. The value of those bonds are falling. And so again, that's just a basic concept. They work in an inverse relationship. So what happened at Silicon Valley Bank was that all of the assets that they were holding had dropped in value. Then they went out and they tried to sell their bonds, and they sold at a loss. They sold at nearly a $2 billion loss. They had about a $1.8 billion loss. That all obviously was not a good look. So then they went out and they tried to raise equity. That failed. So they were showing to the marketplace, that they're struggling. And at the same time, they were getting these depositors who were coming in trying to take money out of the bank. And they didn't have the capital to be able to pay those depositors who said, give me my money back. So all of that in concert is what happened essentially at Silicon Valley Bank and caused them to fail. Got it? Okay, so now we've kind of explained what happened there. Now I want to do a little bit of an explanation about the Fed and interest rates being raised and how this affects your money. Because we often hear, the Fed has raised rates. And sometimes people think like, okay, the Fed raised interest rates and now my my car loan interest is going to go up, or my mortgage is going to go up, or something that I have and that I'm borrowing for, the cost of that credit is going to become more costly to me. Well, it doesn't exactly work like that. So let me explain to you some of the terminology, what it means, and how this absolutely does impact your wallet. So first of all, the Fed sets something called the Fed funds rate, and it's a target that they set. So the Fed funds rate has been as little as 0% when the Fed was artificially keeping interest rates very low. This was, back in 2008, 15 years ago, it was at 0%. The Fed funds rate was also at 0% in 2020, in the wake of the COVID pandemic. After that emerged, and they were like, oh my gosh, what can we do to help the economy? What do we need to put in place? The Fed funds rate, the target back then was at 0. But even in recent years, up until about a year ago, it was still near 0. They had a range. It was about a quarter of a point, 0.25%. So what happened starting in March 2022? Well, the Fed, as I mentioned, started embarking upon this aggressive interest rate hike campaign. And now the Fed funds rate is currently the target rate is set at between 4.5% and 4.75%. Okay? So, but what exactly is the Fed funds rate? Well, this is the benchmark rate essentially that banks charge one another for overnight lending. So I want you to kind of understand this concept and how it applies to the prime rate, because that's another interest rate kind of barometer, and it's another term that you'll hear. Generally speaking, the prime rate is about 3% higher than the Fed funds rate. Okay, so just kind of put a little note next to that. And the prime rate is the rate that banks offer to their very best clients, the ones that they consider primo in terms of, trustworthiness and credit worthiness, the ones that they absolutely know I'm going to get my money back. If I loan money to them or if I extend credit to them, I'm going to get repaid. And guess what? That's usually not you and I. It's rare, if ever, that an individual can get literally the prime rate. We usually get prime plus a certain amount, and they call it a margin, and that extra margin is, profit for the bank. So first of all, recognize that prime is tied to the Fed funds rate. Again, it's usually 3% or so higher, but usually we're not getting the prime rate itself. That's typically reserved for and goes to corporations, institutions, organizations. They are deemed like the ultimate in credit worthiness, that if they are afforded loans or lines of credit, that they're deemed highly trustworthy, credit worthy, etc., and that they'll repay those. Okay, so the Fed funds rate, as I mentioned, has been as little as 0%, but it's been as high as 20%. That was back in 1980. So right now, the Fed funds target rate, as I mentioned, being between 4.5% and 4.75%, it's certainly higher than it's been, in recent memory, in many years. But imagine what it was like back in 1980 when it was at 20%. We had like raging, interest rates. So there's a huge difference between now and what we've experienced certainly in years past and decades ago. Big difference there. And I wanted to make sure that you, kind of fully understood that. Now, since the Fed has lifted its target for the Fed funds rate, and then the prime rate moved in relation to that, what does this all mean for you and your money and the ways in which you have to borrow? Well, that prime rate is very much associated with anything that has a variable rate attached to it. So if you have, for example, a home equity loan or a home equity line of credit, for example, that's a variable rate product typically. If you have a credit card, if you have maybe a business loan, all of those types of things, or even if you have a mortgage that is an adjustable rate mortgage or an ARM, as opposed to having a plain vanilla fixed, 30-year type of mortgage, fixed rate mortgage, any of those things, that business loan, that HELOC, that credit card, or that ARM, that adjustable rate mortgage, yes, those are going to be very much tied to the prime rate. And if that prime rate moves, then your interest rates on those things are going to move as well. That's why we've seen lately, when we've had rate hikes by the Fed, again, them raising the Fed funds target rate and then the prime rate moving up higher as a result of that, we've seen things like credit card interest rates rise as well. And right now we have about $1 trillion in credit card debt outstanding. So a lot of people got a lot of credit card debt, right? And so, yes, people are starting to feel the pinch of this and to see that if you're holding a balance and if you're not paying off your credit cards in full, or if you have a home equity line of credit, let's say, you've probably noticed that your rate has increased and therefore your minimum payments have increased, or the amount of money that you're paying to carry that debt has absolutely increased. So, what's next? I want to wrap this up and talk a little bit about what is next. So the Fed's next meeting is March 21st and March 22nd. The Fed's FOMC, the Federal Open Market Committee, meets, and then they're going to tell us what they're going to do and whether or not they're going to raise rates again. Let me tell you what Wall Street is betting at this point and what the, consensus, if I can use that word, is currently. I don't know that there's a true consensus or an agreement on what the Fed is going to do, but I can tell you momentum has shifted dramatically in the wake of these bank failures. People are like, there's absolutely no way the Fed can keep raising interest rates at such an aggressive level because it's going to produce harm. It's going to potentially lead to other bank failures. It's going to lead to massive layoffs. They're saying, listen, this cannot continue, right? This is what some observers, especially critics of Fed policy, are saying. And I actually agree that the Fed will not be as aggressive. We won't see like a 3/4 point rate hike. Before all of these most recent bank failures happen, and again, I'm saying all of these, let's put it in context. We have over 4,700 FDIC insured banks right now in America. And over the past, since 2001, we've had, I think it's 560, just above 560, maybe 562 bank failures. Most of them happened during the 2007-8, during that mortgage meltdown, during the so-called, Great Recession that we had back then, that in 2008, around that time period. Most of those bank failures actually happened then. So generally speaking, bank failures are relatively rare. The last one happened in 2020, I believe. So it's not like we see bank failures all the time. This is not a very common occurrence. Nonetheless, the Fed does not want contagion. They do not want to see more systemic risk. That's one of the reasons why they put in place some of what I articulated in terms of, this $25 billion fund to be able to allow banks to get money from one another if necessary. So, to be able to borrow from the Fed, actually, based on the assets that they're holding. Particularly, a lot of banks actually hold treasury securities. They hold government issued bonds, in effect, right? And they don't want them to kind of take a loss on those in the same way that Silicon Valley Bank did. So I'm going to get back to that. I wanted to put a little asterisk because I said I wanted to talk about when banks kind of need to borrow. But in a nutshell, I don't think that the Fed is going to be as aggressive. Right now, I think most market watchers and observers are thinking that maybe they'll do like a 1/4 point hike. Some have said they're not going to hike at all. They're going to just stop all interest rate increases at this point. I don't know if I really buy that. The reason is they have just hammered home to the marketplace that we need to get inflation under control. We're setting this 2% target and we're trying to, do this balancing act. We want to have, kind of this medium, not a soft landing, if you will, but we want to have balance in terms of what the economy is able to do to still grow and to still thrive, but not get so overheated. And so if Powell and company, Jerome Powell, and if the rest of the Fed leaders just sort of capitulated at, kind of the first sign of trouble here, I'm not sure what kind of signal that would send to the market, and whether or not people would take the Fed as seriously or as credibly, etc., in terms of monetary policy. So I do think that they'll dial it back a little bit. And my guess is just as, I'm giving you what is an informed opinion, I think, but certainly none of us has a crystal ball. And I think that they'll probably dial it back a little bit, maybe go to, say, a quarter point rate hike, but it remains to be seen. They're going to look at a lot of data in addition to, what's going on in the economy generally. They're going to look at CPI, Consumer Price Index. They're going to look at retail sales. They got a lot more. They're going to look at some employment data as that comes in each week, etc. So they're going to be making decisions based on a number of indicators that say how aggressive do we still need to be. So overall, though, I do think that most observers think that rates as a whole in 2023 are going to be higher than we saw in 2022. So that is definitely the consensus. Now, for those of you who are like, I want to get a new credit card, I want to get, a student loan to pay for college education or for my kids' college education, I want to finance an automobile, I want to buy a house, you're absolutely going to want to pay attention and keep staying plugged into what's happening, because there is a lot that is still up in the air. There is a lot to be decided. And I think that this upcoming March FOMC meeting is going to be one of the crucial ones. By the way, the FOMC meets 8 times a year, and then they come out with their decisions, and they also telegraph other things to the marketplace. So the market is also going to be looking at their forecast, because they will indicate their forecast for inflation, for unemployment, and for other things. So people start to kind of read the tea leaves and look at the Fed's statements and to better ascertain the Fed's own outlook, because all of that does influence the direction, as I've explained, of rates, either sort of, indirectly or directly in some cases. So there you have it. We know that the Fed does not want to lose this battle against inflation. We understand kind of what they've been doing. The only other thing I wanted to make sure that I explained was about the banks themselves and about them sort of loaning money to themselves, because I explained to you that the Fed funds rate is essentially the rate that banks charge one another for overnight lending, right? So I want to kind of better explain that in layman's terms, and just explain why is it that banks are loaning money to one another anyway, and how does this work in effect? So first, remember how I explained to you that when we put our money on hand at deposit with an institution, the institution can then do things with the money. They can invest it. They can use it to, primarily to make loans, and they're making profit off of those loans, to extend credit to others, right? To individuals or to institutions. Okay. However, banks can't just loan out the money one for one, dollar for dollar. So let's say a bank has, $400 billion in deposits. They can't just make $400 billion worth of loans or extend $400 billion worth of credit, because federal regulators have guidelines in place that say they can only make loans, they can only do with the money a certain percentage amount of the deposits. Okay, they have guidelines around that. So because everything is dynamic, it's not static, it's constantly moving. Depositors may be coming in, putting in inflows. Some people may be taking out money. Some people might have had a CD that matured. Some people might just had cash on hand. They took that money out. Some people come, they have new clients. And of course, because there's fluctuating things that are happening in the marketplace, whether that's interest rates that are changing, etc. The banks have to make sure that they not only have the cash on hand to be able to, give to depositors if people come back and say, give me my money, but they also have to have reserves on hand in compliance with what regulators require. Okay? So at any given point in time, in order to make sure that they're meeting their regulatory capital requirements, the banks, just for a quick period, just for overnight, might need to have money on hand on deposit to make sure that they're meeting their reserve requirements largely. So think about it like you and I, if we have, this is just an analogy that came to my mind in terms of explaining it. When you and I have money on deposit with a bank, let's say we have money in a checking account, and then let's say that we have, recurring payments or something that's being drafted out of our checking account. It might be your utility bill that you have that's being paid. But then let's say you have other things. You wrote a check or you did an electronic transaction, and that electronic transaction is going to hit your checking account. But let's say, overnight, that recurring payment hit and the electronic payment that you put in there, all of those hit at once. And you might have overdraft protection, or you might have a standby line of credit, or you might have your savings account in the background to cover you in the event that multiple things hit all at once, and that would back you up so you wouldn't have, say, an NSF charge or a non-sufficient fees charge. You wouldn't go into overdraft. I'm kind of using that analogy to say that this is a little bit akin to what's happening in the banking world. I don't know if it's a pure, perfect analogy, but I just want you to conceptually get kind of what's going on with these banks when they're doing this overnight lending. They have funding needs and they have reserve requirements as well, just like you and I have funding needs to pay our normal bills, to be able to, operate and manage our finances, and to cover, what if this one comes in on time, or at a given time, or multiple things hit all at once. So there you have it. I think I've kind of covered the Fed funds rate, the prime rate, a little bit about FDIC insurance, which again typically covers you for up to $250,000 in insurance, but they're going way above and beyond that. They're using what's called an exemption for systemic risk to protect those customers of Silicon Valley Bank and of Signature Bank, well above and beyond the $250,000 threshold. So they'll be covered. Don't cry for them. They're good. They're all right. Like I said, can we get some of that same energy for MSIs, minority serving institutions, for Black-owned banks, Hispanic banks, and others? That's a topic for another day. But some of these things are still up in the air. We're going to see, I don't think that we're going to have, major runs on banks all across America. I don't think that's going to happen. But there are some questions about, obviously, the direction of interest rates, how aggressive the Fed is going to be, and whether or not Fed policy is going to continue in the same vein, or whether or not they're going to kind of capitulate or slow down a little bit on these rate hikes. So this has been Lynette Khalfani-Cox, the Money Coach, explaining some of the stuff around bank failures and what it means for your money. I hope you've learned a lot in today's video message.